Mohammed, my co-chair. Good morning, Mohammed.
Good morning, everyone. Sorry for being late.
Not a problem. We're just off to a roaring start here, so just getting going. So as I said, I'm going to turn the meeting over to Sham in just a moment. We have a single item on the agenda. This has actually been a topic that's been we've been wrestling with now for well over a year, maybe even going on 2 years now. The initiation of this was really the difficulty in finding funding for early stage private companies. For those of you that aren't necessarily involved with industry, these days it's very difficult for early startup companies to find funding. We've gone from what's known as a risk-on environment to a risk-off environment where people are less willing to take risks, particularly people that fund early companies. And it's very different from the roaring days of 2020 and 2021. And the observation was that this is basically we have a co-funding obligation, a cash co-funding obligation for companies to get CIRM funding, and that requirement for cash co-funding was creating some problems for very young companies to be able to apply for and obtain CIRM funding, even though they might have very excellent opportunities, scientific opportunities for potential therapies for unmet medical needs. So the idea came as an alternative to providing cash co-funding was to use the equity form known as warrants or rights to buy stock in the future as an alternative. And so I think we finally come to the point where we have something concrete to put on the table, which Sham will explain. I think Mohammed and I have been very much involved in the development of this, and I will speak for me. I think I'm speaking for him as well. We're very much in support of what Sham is proposing. I think it's an elegant and wonderful, great outcome, and we'll tread that line between helping young companies who are having difficulty finding money, but still providing an opportunity for a return to CIRM on the co-funding aspect of it that CIRM will actually put up in the form of money rather than requiring the company to put up. So with that very long-winded introduction, I'm going to turn this over to Sham, and once he's done, let's go through the whole presentation, if you don't mind, and hold the questions till the end, and then we can refer back to slides as we need to. And with that, Sham.
Steve, actually, this is Scott. If we could just take a quick roll call and just establish the quorum, and then hand it over to Sham.
We have a roll call taker.
Yes, we do. I'll take the honors. Mohammed Abu Salam.
Present.
Kim Barrett.
Present.
Maria Bonneville.
Present.
Judy Chow.
Present.
Anne-Marie Delege. Larry Goldstein.
Here.
Vito Bassiani.
Here.
Steve Julesgaard.
Present.
Shlomo Melmed.
Present.
Joe Panetta.
Here.
Michael Stamos.
Present.
Carol Watson. Great. Thanks very much, Steve. Sham?
Thanks, Scott. So thank you, Chair Julesgaard and Chair Abu Salam, for this opportunity to present to you today, and thank you to the committee for your time and attention this morning. So I'm going to walk through the presentation that Steve has elegantly outlined. And given that it's been a while since we have discussed this topic in the past, I will do my best to provide background as well as explanation for the rationale for what we're proposing today, and happy to take any questions at the end, as Steve mentioned. I also want to acknowledge that we did make a change to the presentation materials and the proposal recently, and that we believe in the end has resulted in a better proposal, and I'll walk through some of those elements as well. So if you'll pardon me for a second, I'm going to put up the slide deck. All right, Scott, can you see the presentation and can you hear me okay?
We can, to both.
Thank you. All right, so I'm going to launch right into it then. So we always start every meeting with our mission statement, and which is to accelerate world-class science to deliver transformative regenerative medicine treatments in an equitable manner to a diverse California and world. So in taking the committee's feedback roughly a year ago, what we ended up doing was going back and taking a look at the co-funding requirement in a more holistic manner and determining what was the intent of that co-funding. So going back all the way to the ICOC meetings in 2014, 2015 timeframe when CIRM 2.0 was being launched and the CLIN program was up for board approval as a new concept plan. And so from that, what stemmed was this particular co-funding mechanism, which you are all familiar with, where there is a co-funding requirement on the total project cost for all for-profit applicants for the translation and clinical programs. For the nonprofit applicant, the co-funding requirement applies at any trial that is after the first in human trial. So basically any late-stage clinical trials, there is a co-funding requirement. And so what was the intent of this co-funding requirement? And for the for-profits, the intent was that we wanted the companies to demonstrate a firm commitment to the proposed project. And that's what's been discussed, over the last year or so as to how do we maintain this commitment while also providing for a warrant-based co-funding option that allows preservation of capital for these young companies. And the second element for the nonprofits, for those later stage clinical trials, the intent there was to have an industry partner for those late stage clinical trials and to incentivize that sort of partnering for those trials when they do come in. And so what we're requesting and what we're proposing in this particular presentation is to make changes to the co-funding requirement based on 3 particular areas. So the first and foremost is something that we've discussed in the past, which is that for-profits are operating in a challenging economic environment. So there are very much acute headwinds at the moment. And then more generally speaking, young companies that are in development phase are almost always cash strapped. And going further than that, they are at a relative disadvantage to nonprofits for certain award levels. And what I mean by that is that in our current funding programs, for-profit companies cannot request overhead costs. So that's a 20% overhead cost that nonprofits can request. In addition to that, both the CLIN 1 and the First in Human CLIN 2 program, the award caps right now are lower for companies than they are for nonprofit applicants. So keep that in mind as we go through this presentation. Secondly, if a nonprofit applicant has a for-profit partner at the time of application, that partner is not required to co-fund the CIRM award because currently the co-funding requirement applies to the applicant or awardee. And lastly, currently clinical progress of unpartnered academic programs, these are ones that don't have a commercialization partner that are at late stage clinical trials, are unable to raise the 40% co-funding requirement. And this is particularly stalling these programs as they try to raise additional funding and have to delay the clinical development of these programs. And we've seen this firsthand. Both Dr. Albuquerque and the therapeutics development team, as well as I and the business development team have witnessed this firsthand with several CIRM projects. And we can talk about that if needed down the road. I see that Michael Stamos has his hand up.
Yeah, sorry, Sham. On the first bullet point, there were 2 points. Could you repeat the second point? I don't think I quite caught that. I wanted to process it a little better. Thank you.
Yeah, certainly. So for the second point was that for a CLIN 1 funding mechanism, this is to support IND enabling projects. A for-profit applicant can only request to the award cap of $4 million, while a nonprofit applicant can request $6 million. Similarly, for a CLIN 2 mechanism, that's a first in human trial, a for-profit applicant can request $8 million and a nonprofit applicant can request $12 million. And the reason for this is because the co-funding is supposed to bring that to an equivalent level. So with that in mind, what we're proposing is a change to the co-funding requirements as outlined in this particular slide here. So I'm going to focus you first on that middle table. And so what we're proposing is to allow for a warrant-based co-funding option for profits. And then for the nonprofit side, we're splitting out the partnering status of the nonprofit. So if it's a nonprofit applicant that is unpartnered, they don't have a commercialization partner at the time they submit an application to CIRM, they will not have a co-funding requirement at any stage of a TRAN or a CLIN award. Now, on the other hand, if that nonprofit has a commercialization partner when they apply to CIRM, the partner will be subject to a cash or warrant-based co-funding requirement. So essentially, it's equivalent whether the for-profit partner applies or the nonprofit applies in that situation. The co-funding requirement would apply to both. Now I'm going to come back around to the warrant-based co-funding requirement. So as Steve mentioned, this is something that we had discussed a year ago as an alternative mechanism to the cash-based co-funding requirement. So here, the applicant would elect to take the warrant-based co-funding as an alternative option to committing cash. And CIRM has a history of this. So previously, CIRM had required awardees to issue warrants as part of a prior loan program. And in that instance, the warrants were managed by a community fund when it came time to exercise them. So they exercised and liquidated the shares and then transferred the funds back to CIRM. So there is a mechanism in place, and there's a history of this that CIRM has used in the past, which is the main rationale for why a warrant-based co-funding option is feasible for an organization like CIRM. So just to repeat, what we're proposing is a set of changes to address those 3 bullet points in the prior presentation. So first, with respect to companies that apply to CIRM, and to give them an option aside from the cash-based co-funding requirement, there's going to be the warrant-based co-funding requirement, which I'll describe in the next few slides. And then there were 2 nonprofit situations that I mentioned. The first was that a commercial partnered nonprofit, when they apply, the commercial partner has no obligation to co-fund the project because the co-funding applies to the awardee. Under this proposed co-funding change, that commercialization partner would be subject to the co-funding requirement, just as any other for-profit applicant would be. And finally, if a nonprofit program is unpartnered at the time of application, they will have no co-funding requirements at any stage of the translation or clinical awards. So I'm going to now first address the nonprofit co-funding changes, and then I will focus the rest of the presentation on the warrant-based co-funding. So as I mentioned previously, the 40% co-funding requirement for nonprofits for any trial beyond the first-in-human trial is not really serving as an incentive for industry partners. It is not by itself encouraging an industry partner to partner with that program. And in fact, is slowing clinical progress based on our experience. Now, I do want to note that although we're proposing to remove this co-funding requirement, if that nonprofit applicant already has a commercialization partner, the co-funding requirement applies to the partner as I described in the prior slide. So that co-funding commitment is still preserved if there is a commercialization partner for that program. So what would be the rationale for supporting unpartnered later stage clinical trials that have an academic sponsor? So in these instances, these trials can progress. They can generate, if they're recommended by the GWG and approved by the board, they can generate additional clinical data and progress that program and further de-risk it and eventually attract partnerships or alternative models to deliver those therapies to patients. And this co-funding requirement is slowing down that progress that could potentially be made in the academic setting for those trials. And I do want to remind the board that the revenue sharing and loan conversion would still apply to all these awards. So for that nonprofit CLIN 2 of a $15 million award, that would still have the revenue sharing requirement as all CIRM awards do apply to it. And so for that $15 million CLIN 2 award, that could result in a 1.5% royalty on revenue if that program is successfully commercialized, up to a return of $135 million over up to 10 years. Similarly, if that award ends up being converted to a loan after it has ended, we would, at a minimum, have a return of principal to CIRM. And those are the standard loan conversion and revenue sharing requirements that apply to all CIRM awards for translation and clinical stage, which is pointing out that even if we do make a $15 million CLIN2 award to an academic program for a late stage clinical trial, there could still be a return to CIRM down the road if that program is successfully commercialized. So I'm going to focus the rest of this presentation on the warrant-based co-funding mechanism that is relevant to to for-profit awardees or potentially to the for-profit commercialization partners of nonprofit awardees. So how would this program work? So a for-profit awardee would commit warrants instead of capital, as we mentioned. In this instance, the awardee retains capital for operational needs and value creation that it would have otherwise have to have committed to the co-funding requirement. And in return, CIRM would have to commit a higher award amount up to the award cap to maintain overall financial support of the CIRM-funded project. And this was described in the prior IP subcommittee meeting, and I'm going to re-describe how this actually would work in practice. And how would it impact a particular project. So I have two examples here. I'm going to walk us through the translational one, and the clinical one is similar, but with higher amounts. So currently, let's say that a translational project is submitting an application to CIRM where the total project cost is $4 million. In our current paradigm, the applicant can request $3.2 million from CIRM. This is a for-profit applicant. They can request $3.2 million from CIRM with the expectation of a $4 million direct cost award limit. Because they're required to put up 20% co-funding, the awardee would have to commit $800,000 as the co-funding amount on that $3.2 million CIRM award to cover that total $4 million total project cost. If the current co-funding changes are approved, that applicant would have the option to take the warrant-based co-funding. So in this particular scenario now, on the right side with the light gray row, the CIRM award to the applicant can request up to $4 million, which is the limit of the CIRM award, to cover the full $4 million of the total project cost. They would not have to put up the cash co-funding of $800,000. But since CIRM put up the $800,000 to cover the project, the awardee would have to provide warrants to cover that portion of the CIRM award, the $800,000 that can be attributed to the co-funding amount. So here, basically, the warrant coverage has to represent $800,000. So that second row, which I'm not going to go through, simply describes how this would apply in a CLIN2 setting, where the dollar amounts are generally just higher. And you can see that in that table down there. But generally speaking, there's going to be a subset of projects and awards where taking the warrant-based co-funding option is meaningful to the awardee. So when this was presented to the committee about a year ago, there were several points that were raised, and I'm going to go through those, and I'll address them one by one. So in developing a proposal that met the community's expectations, we took a lot of things into consideration, and we sought feedback from a lot of different stakeholders. So first and foremost, both Steve and Mohammed were steady partners and advisors along the whole process as we were developing this and making the changes that were necessary. We also sought feedback from venture capital partners, from our awardees. We also worked with an outside counsel to develop the terms and to get feedback on legal as well as tax items. And we also contracted with an accounting firm, EY, Ernst & Young, to get feedback on the accounting implications of these terms. And all that feedback has coalesced into the plan being proposed in the next few slides. So now to come back around to the subcommittee's specific feedback at the prior meeting, there was a need to ensure that the warrant-based co-funding commitment measures up to the cash-based co-funding commitment. It was also a need to determine if there is a necessity to allow the awardee to buy back the warrants after the award has ended. This is an analogous sort of situation to our current loan conversion program, which is meant to not be a barrier for partnering and commercialization. And lastly was to define company eligibility criteria for election of the warrant-based co-funding requirement. So in the next couple of slides, I'm gonna outline how we've addressed this feedback from the committee. And as I noted, with feedback and work from all the different stakeholders. I'm going to start with the first 2 points first, and then get to the third point. So this is going to get into the weeds a little bit of the warrant terms. I did have animation that would have made it easier to read the slides, but it's not working. So please bear with me. There's going to be a lot of text and tables on the next few slides, but I'm going to try to focus you on the relevant points as best I can. So apparently it's going to work on this slide. So great. So first of all, the for-profit applicant has to elect the warrant-based co-funding option at the time of application. And they will have a lot of information to make this decision. So they'll have a CIRM term sheet, they'll have FAQs and other reference materials that will be posted with the PAs. And then the applicant always has the option of combining the warrant-based and cash-based co-funding, which could make sense in certain scenarios. So commensurate with CIRM's commitment of its award upfront, and here in these instances where the warrant-based co-funding option is selected, we are giving more money to that awardee, and we're committing that money as soon as the board approves the award. We expect that the awardee will issue its warrants to CIRM at the award start. And lastly, on this particular point, there will be no mechanism for buying back warrants during or after the award period. So once those warrants have been issued to CIRM, it is to CIRM's decision-making as to when those warrants are exercised, if at all, or if they're sold. And we saw a lot of feedback on this particular point, and universally, we were advised that investors, acquirers, and even companies when they go public are able to account for any warrants that they may have. And thus, there was a very low risk of warrants to CIRM being a bottleneck for partnering and commercialization of these programs or these companies. And it also demonstrates the commitment in this particular instance that's roughly equivalent to the co-funding commitment. So this is where we get into the weeds a little bit with the warrant terms. So in order for a company to be able to issue warrants at the award start, we had to account for the 3 types of companies that usually apply to CIRM. And that's what we have laid out in this chart here. And I'm going to go over some of the terms and explain them. And then I've reserved one particular important term for the next slide. So I'm going to start with the left column first, the private company. So these are going to be, there's 2 types of private companies that apply to CIRM. And the first is companies that are very early stage. They have not issued any preferred shares, so they have not raised any preferred share financing. For simplicity, we can assume, a venture-backed financing. In these particular instances, we needed to find a way for these companies to be able to issue warrants to CIRM at the award start. So a security type here would be a common stock warrant. And to ensure consistency across these very young companies, we would peg the number of shares that they would have to issue to us as 1 share for every $1 of the CIRM award amount that is attributed to the co-funding. So in that prior example, $800,000 would be 800,000 shares. Now, we do reserve the right here to make modifications to this formula if a company's particular situation warrants it. And then the warrant term here will be 10 years. And this is to be able to hold the warrants long enough to realize a return on a liquidity event. For example, a merger, acquisition, or an IPO, an initial public offering. In this particular situation, to harmonize it with the rest of the private companies, CIRM would reserve the option to convert the common stock warrants to preferred stock warrants at the next preferred share financing. And this is to ensure that if that does return in the value to CIRM, that we would take that option. So this would be an instance where the preferred stock price is much lower than the formula that we had used for the common stock number of shares, and that would give us an option to convert to the preferred stock warrant to get the appropriate value for CIRM as the same value as the investors who are putting into that company at that time. So I'm going to now switch to the middle column, which is the private companies that have issued preferred shares. So they've had some sort of preferred share financing. This represents the majority of companies that are funded by CIRM. So in this particular instance, the security type would be a preferred stock. And so it'd be a preferred stock warrant. And the number of shares would be a fairly simple calculation here, where we would take the amount of the CIRM award that is attributed to the co-funding. So in that prior example, $800,000. And we would divide that by the preferred share price of the most recent equity financing. So if, let's say if the preferred share price, for simplicity's sake, was $1, and that's how much the investors paid for the preferred shares, in that particular instance, that would determine how many shares we would get. So $800,000 of CIRM funding would result in a $1 preferred share price would be 800,000 preferred share stock. The warrant term here remains the same, 10 years, and there is no need for a CIRM option, so none exists. And lastly is the public company. And so if a public company were to apply to CIRM and wanted to elect a warrant-based option, in this particular instance, we'd go back to a common stock warrant. And the formula for determining how many shares CIRM would get will be based on the amount of money that CIRM is, amount of the CIRM award that is attributed to the co-funding amount divided by the average closing price of that company's stock over a number of days. And that formula is described down below. It's basically taking the average of a 10-day trading period ending 5 days prior to the date of exercise. And those are fairly standard terms for a common stock warrant in a public company. So that's the schematic that would allow for all three of these types of companies to issue warrants to CIRM at the start of the award. Now, what makes these warrants roughly equivalent to the co-funding requirement is the fact that the companies required to issue those warrants at the start of the CIRM award, that there is no real mechanism for them to buy back those warrants later on. And the last part of that is the concept of pre-funded warrant. And I'm going to describe this as to why this is relevant in this particular scenario. But the one part that was left out of the previous slide was the exercise price. So by way of background, when warrants are issued to a warrant holder, they are essentially a right to buy stock in that company. And there's a specific price associated with buying that stock, and that's called the exercise price. And that could be set at any number of things. In certain situations, it's set at a penny, and they call that a pre-funded warrant. And that is what would be the terms for a CIRM award. And so what this essentially does is that it values that CIRM capital that went into that award that is attributed to the co-funding amount similarly to investor capital in the company. And I'll describe that in this hypothetical, very simple scenario down below. So in this scenario, let's assume that we're talking about a private company that issued preferred stock warrants to CIRM. And to keep the math simple, the co-funding coverage was $1 million. So essentially, they elected to issue warrants to CIRM to cover that $1 million. So how would this be calculated? So at the time that the warrants were issued, we would take the preferred share price of the most recent equity financing, which in this scenario is $1. We would take how much was the co-funding coverage from CIRM? $1 million. That would result in 1 million shares. Now, what I have on this table is the effect of the exercise price being a penny. And on the right column is the effect of the exercise price being what we previously proposed to you a year ago and what was part of the loan program, which is where the exercise price is set at the preferred share price at the time of the issuance of the warrants, in this case, $1. So when it comes time to exercise these warrants down the road, what would it cost CIRM or whoever the warrants were sold to? So in the pre-funded warrant scenario, it would cost $10,000 to exercise the warrants to get the 1 million shares. In the loan program terms, where the exercise price was $1, it'd be $1 million. So what's the true cost of this now? So we would add up how much co-funding CIRM put in, plus the exercise costs. And for the pre-funded warrants, that's $1,010,000, which is roughly equivalent to what the investors originally paid at that time when they invested in that company for the preferred shares that are the same ones that CIRM would exercise to get access to. So that's what I meant when indicated that it's similar to investor capital in the company. On the other hand, if exercise price is $1, the effective cost of those shares would be $2 million because there was the original CIRM co-funded award amount plus the exercise cost of $1 million. Now, in most instances, if the warrants are in the money, essentially what that means is that the current value of the shares is above the exercise price, and exercising and liquidating would result in a return. The appropriate election may be to do a cashless exercise. Essentially, the number of shares issued by the company to CIRM accounts for the cost of buying those shares. So to keep this simple, I'm going to do a $5 share price at the time that the warrants were exercised. In this scenario, under the pre-funded warrants, the number of shares that CIRM would get is 998,000 shares to the warrant holder. And just to confirm the math here, it's the 2,000 shares times $5 is $10,000, the cost to exercise. On the other hand, with the exercise price being at $1, it would be 800,000 shares. And again, to confirm the math, it would be 200,000 times $5 to get to the million. So no, the point of this is that by using the pre-funded warrant mechanism, there's better value for the warrants that is commensurate, again, with the co-funding commitment for this particular award. And that's the main takeaway from this slide in my long explanation. So I'm going to quickly now cover the eligibility requirements, which was another directive from the subcommittee. So before I do that, I do want to quickly touch on what our current solvency and co-funding requirements are for all for-profit applicants. So anytime a company applies to CIRM, they are subject to eligibility requirements for solvency and co-funding. So what do we mean by the solvency requirement? So when they apply to CIRM, they have to demonstrate that they have enough cash on hand or committed funding to cover the operational costs for 180 days beyond the date of application submission. And the main reason for this is because we're using taxpayer funds to review the applications of these companies. They need to be around by the time a decision has been made. Secondly, if they have to commit co-funding and contingency funding for that project, at the time of application, they must demonstrate how they're going to use any cash on hand, any committed funding, and any planned fundraising to meet those co-funding requirements. And we evaluate all of that at the time of application submission. Now, over the course of the award, the co-funding requirement is checked. So they must indicate the amount that they spent on co-funding for any given milestone, because the co-funding is in lockstep with the CIRM funding. And secondly, they must provide evidence of their ability to co-fund the next milestone. So those are the award reporting requirements that they're subject to over the course of a TRAN or a CLIN award. So with that as background, we would need to apply a relevant additional eligibility or award reporting requirements for the companies that select a warrant-based co-funding option. So this table here is only describing to you the additional requirements, not all the standard requirements, co-funding, solvency, any award requirements that are subject to all awardees still apply. This is just to describe the additive warrant-based co-funding requirements. So, and again, I'm splitting out by the three companies. So let's start with the earliest stage company. When they apply to CIRM, they have not raised a significant round of financing at that point. So when they submit the application, the eligibility criteria will require them to provide us a detailed fundraising plan that outlines how much money they plan to raise, what sort of financing they're looking to do, and whether they have any commitment so far, and how do they justify raising that amount in the amount of time they describe. Now, at the time of the award start, that awardee would be required to issue the common stock warrant to CIRM, as previously mentioned. And over the award period, they would have to notify CIRM if they had a preferred share issuance. So for example, if they raised a preferred share financing, because that allows us to elect to take our option to convert the warrants to preferred shares. And secondly, because these are young companies that are going to be enacting on a fundraising plan, the CIRM business development team will utilize the Industry Alliance program to assist this company's fundraising effort as needed. And so that's for us that, we usually will help companies when they ask us. In this particular instance, we'll be more proactive in working with these companies that are very early stage. I do want to be clear here that there is no requirement that they close that fundraising round during the course of the award. That would be, there are lots of instances where they may raise a fundraising that does not result in a preferred share financing, and also that there could be circumstances outside the company's control. And so essentially the eligibility requirements tell us provide a reasonable plan for that to keep the company going forward, and then to issue the common stock warrant to CIRM at award start. For the private company that has had a preferred share financing, the eligibility criteria would be tell us your fundraising history, confirm that you did raise such a round, and then provide a letter of support for the CIRM project from the lead investor. And so this is a confirmation to CIRM that the investors and the board of directors of that company are committed to the project that is being proposed to CIRM. At the time of the award start, they would issue a preferred stock warrant to CIRM, as previously described. And then lastly, and they would have no specific award period requirements that have to do with the warrant-based co-funding. Lastly, on the public company, there's no eligibility requirement that is specific to warrant-based co-funding, but at the time of the award start, they would still have to issue to CIRM the common stock warrant. And there are no award period requirements that are specific to the warrant-based co-funding requirement for these companies. So that's a lot of information, and we'll get to it again if needed during the Q&A process. So I'm almost done, just a couple more slides. So if this program is successful and it is helpful to companies, there'll be a portfolio of warrants for CIRM to manage. So how is this going to be done? So I'm briefly describing that here. So first and foremost is to negotiate, issue the warrants to those companies. Negotiate and have the warrants issued to CIRM from those companies. So this is going to be managed by the CIRM team with support from our outside counsel. Also, when you have a portfolio of warrants, there's going to be compliance monitoring. There's going to be keeping track of the companies. There may be routine sort of adjustments or agreements, changes to the capitalization of the company that need to be managed and reviewed. And those will be done by the outside counsel as well, along with support from the CIRM legal counsel. And lastly, if there is the opportunity to exercise the warrant upon a liquidity event, this will be done through a fund managed by a California Community Foundation. This is similar to what was previously done with CIRM warrants that were issued as part of the loan program. So that fund would exercise the warrant, they would liquidate the shares, and then transfer the cash proceeds to CIRM. And so as part of our due diligence effort in the past few months, we have reviewed proposals and fee structures from the leading California community foundations and are prepared to move forward with the leading candidate if this program is approved. And we've arrived at the last slide. And just to kind of recap the process for this. So if this committee recommends the co-funding changes in this meeting, then these will be wrapped up into other concept plan changes that are planned for the translation, clinical, and CLIN 1 and CLIN 2 programs, which will all go to the science subcommittee for review at the end of this month. And if those are recommended by the science subcommittee, those concept plan changes would then go to the board in December for approval. And the concept plan is simply going to describe the warrant-based co-funding option as well as the modified co-funding requirement for the nonprofits. And the warrant term sheet we provide as reference for that. It is not something that we expect would be reviewed in detail by either of those committees. So with that, I'm going to take a pause, take a sip of water, and answer any questions you may have.
Before we have any questions, Sean, thank you for that simple yet comprehensive presentation. As he says, tongue in cheek. Any questions from anybody? Michael?
Yeah, I think that was fantastic, really elegant. I liked a lot of it. I like almost all of it. I just had a question about the not-for-profit. And you mentioned, I think, that the current approach is not attractive to, if you would, investors or private companies, right? Or creating private companies. And I just worry about what would be the unintended consequences of this change for the not-profits, i.e., will it actually disincentivize, if you would, them taking it private or having a private investment, because they could just sit back and say, well, wait a minute, they can get full funding without warrants from CIRM if they don't have an investor.
That's a good question. So are you speaking specifically to the 40% co-funding requirement for the later stage trials, or?
Correct, yes. Yeah.
And so in those instances, I'll say that right now, the $15 million is going to allow them to continue clinical progress. But eventually they're still going to need a partner to commercialize in the traditional sort of, biopharma model that we operate in right now for late stage clinical development and approval and commercialization. And right now, what we're saying is that it's not actually incentivizing a partner to come in, right? So it's not on the flip side of, I guess if we take as demand from the nonprofit and supply from the partner side, it's not actually incentivizing an investor or a company to say, oh, there's a 40% co-funding requirement, so I should partner with this program, right? So that's kind of why the intent is not being met. With respect to whether that incentivizes academic programs to continue keeping that in-house rather than shipping it out, the comment I would make to that is that if the grants working group believes that the proposal that they're reviewing is going to significantly progress that program clinically and scientifically and further de-risk it for future investment, I think that is of value to CIRM.
No, I get that part. I guess I'm worried that this approach will actually not only will it not incentivize it, it will disincentivize that partnership because of the opportunity to get the funding without the warrants. That's my point. If that makes sense.
Yeah, it does.
Can I just speak to that really briefly, Michael? So, I mean, I think there's a line to be walked here. I hear what you're saying, but the issue is really, it's kind of, where is this rare disease line on one side of which commercial companies just don't find it interesting to get involved because they don't see an economic return that justifies the amount that they'd have to invest in the amount of work they'd have to do. There are, however, rare diseases on which, companies will get involved or whatever. And it's hard to know ahead of the fact which side of that line any particular disease and its therapy might lie. So I think what, the way we've struck this is because we're really interested in seeing therapies for these diseases, come forward and be developed and serve the public, that we've erred on that side of promoting science as opposed to worrying particularly about, finding partners and getting a return that way. There is always the return that Sean referred to in terms of royalty on sales that lies at the back of this. But I do believe, and there's a conference next week here up in South San Francisco to talk about rare diseases in their future. We are going to see actually academic centers that are going to wind up having to be the providers of certain therapeutic modalities in rare disease areas, simply because commercial enterprises aren't going to be willing to step forward and do that. So I hear you and agree that that's an issue, but we have to decide, one way or the other. And this is kind of what we thought would be the best solution.
Thank you. That's a good explanation. Thank you.
And to that, I would also add, so Steve covered the rare disease side, where all those academic programs that we currently fund all have made significant good faith efforts to partner. And because of the way that the market is at the moment, is difficult. The other way I would also answer your question is that for earlier stage programs in preclinical or the first in human clinical trial, the academic programs don't have a co-funding requirement. And even in those instances, the programs have sought and secured commercial partners where appropriate, right? So that hasn't been a major disincentive in those instances where they could keep it in-house. If there is a reason to partner and to progress that program, I think that they're willing to do that.
Shlomo?
Hi, thank you. That was really a super presentation. You could go on the road for Morgan Stanley. They'd love it. That was really terrific. Thank you.
Shlomo, we want to keep Sean. Don't be promoting him.
Well, we better raise his salary then to beat them. Yeah. Maybe I missed it, but the very last part, I think needs more clarification for the board. The community foundation, will CIRM be the grantor or the recipient? And who's going to make the decision at the foundation? Are we going to advise the foundation what to do with CIRM's asset? Or is the foundation going to be independent and is going to dispose of the asset and just send us a check once every few years? What's the authority of CIRM over the assets that are lying in the foundation? And who's going to make the decisions? What is our role? Grantor, settlor, beneficiary? So,
Raphael, are you able to address those questions from a legal perspective, or do you want me to take a shot?
Why don't you take a shot, Sean, if you don't mind?
Yeah, so we would be the beneficiary. And so I think as part of the agreement, there would be an expectation that the foundation would liquidate the shares at the earliest possible time.
Who would make that? Who would make that decision physically? Who would press the button to liquidate?
That would be the fund, the foundation.
So we would not be part of that decision?
So we would establish under what circumstances and agree upon that as to when it would be liquidated. And so right now the current mechanism would be that it would be at the earliest time possible.
Sham, could I jump in?
Yeah.
Hi, Shlomo, this is Scott back at the headquarters. So Sham has it right. The direction would come from CIRM through a pre-arrangement, which could be modified even at CIRM's request as to the timing for.
But legally, Scott, sorry, legally, how can we, if we are the beneficiary, how can we direct the foundation? We are the beneficiary.
Well, it's going to follow just as it did when we had the warrants from Geron, which is the foundation just acts as a vehicle to hold it on our behalf and to execute our instructions to liquidate when we make that direction. So they're more or less just a conduit, a formal sort of legal possessor of the warrants. That are subject to our instructions as to when and under what circumstances they shall be liquidated. And in exchange for that, have a small fee associated with that.
But some you mentioned a fund. What is the fund?
I'm sorry, I didn't use the word fund. I think it's really just a foundation that holds them in our place and subject to our instructions.
Yeah, and the way the foundations work is to open up a vehicle, which I refer to as the fund.
What fund?
It's really an account, isn't it?
Yeah, that's just the terminology that they use. That's why I'm using that terminology. But it's
So
essentially
we are the owners and we are the beneficiaries.
That's correct. So Shlomo, maybe it hasn't been clear. We CERM are not allowed by law to hold securities.
Right.
And therefore, we need to go through the foundation process to hold those securities, warrants, whatever, and to execute them. Once those are executed, the foundation makes a contribution to CERM, that with the money.
And that protection does not preclude us from being the decision makers.
Not at all. We're the ones who provide the instructions to the foundation. We're the ones who press the button, if you will, Shlomo, and Shama, please correct me if I'm wrong, but that's my understanding. We're the ones who tell them, okay, we'd like to liquidate or exercise our options and then liquidate the shares, either by a formula or by direction. So.
And how will we? And I'm turning to the chair of the board now. Our chairman there, sitting there. How will we make that decision? Who will advise us that it's time to sell or time to buy or time not to sell?
Good question. You have an answer to that, Scott? I don't.
Pardon?
He's asking me, how do we decide to give that guidance to the foundation?
It's up to the board to decide, of course, but I think traditionally this would be a function of the president and the president's team at CERM within the guidelines established by the program.
Thank you.
Stephen?
He's asking me.
I don't know who's chairing.
Larry's up next.
So I guess I have two simple questions. One is, so do I understand correctly that if we think that the company has long-term increasing value, we can hold our shares and not sell at the earliest opportunity?
Yes. Yeah, it's a 10-year warrant. So, Sham says at the earliest opportunity. I think there's actually more of a judgment that may be applied in all of this. I think one would need to take a look at what we thought the prospects were. Obviously, at the first opportunity that they become available to be sold, the company may just be in the early stages of commercializing a product and not really realize the full potential. So again, I think it relates to Shlomo's question about how these judgment calls are going to be made, and I think that's going to be a work in progress as we move along. But somebody's going to have to say, yes, this is a good time to do it, and I wouldn't necessarily think that it's exactly the very first opportunity, but that's just my opinion. So.
And so to clarify on that point, the first opportunity to sell will be after the warrants have been exercised. So we're talking about we can hold the warrants for up to 10 years. So they're issued to us at the award start. We can hold them for up to 10 years. Once we exercise them, a potential mechanism would be that the fund would liquidate those shares at the first opportunity. So for example, if you think about it as a part of an IPO, that may be in holding period once the shares are once they're exercised, they're converted to common stock in that company. Once that company goes public, there may be a holding period. When the holding period is lifted, that's the first opportunity to sell and liquidate those shares and transfer the funds back. So if you had a particular instruction to do that at the earliest opportunity possible, that would be how that would play out. So I'm referring to the after the shares have been exercised and then how they're liquidated. Not so much that we would exercise the warrants at the first opportunity.
Yeah, I think that really is the question, is when's the date of exercise, because we have this 10-year period. And the day they first become exercisable is not necessarily the day we want to exercise, would be the best exercise. Larry, did that answer? Larry, you said you had two questions, so that was
Yeah. So I'm satisfied and happy about the answers to the first. I think it's good that we could buy and hold if we felt the project was really taken off. I guess second is we have a lot of oversight on some of our more expensive projects. And I guess the question is, if we become convinced that the early trials don't look very promising or the animal data don't look like they're going to survive through an IND, do we have the option, as we do on other projects, of terminating the funding, or is it really an independent entity and they make all decisions?
Well, I think you're speaking to whether, so our funding, as I understand it, is milestone based, right? So we have a contract with a company basically to provide funding, but over the course of that funding, there are certain milestones that have to be achieved. And if they're not achieved, then the funding stops until they are achieved, or if they're not achieved, then the funding stops full stop. So we have that kind of control over, as I understand it, any project for which the ICOC has approved an award. Sean, can you clarify that for me? Is that the way it operates?
Larry, are you referring to our standard award management process?
Yeah, that's exactly right. So I'm sort of wondering what happens if the company does a trial, they think it's great, we don't think it's going to make it. How do we manage that situation? Or is it just that there's a bolus transfer and the company makes all the decisions?
So that's an appropriate question for Dr. Abla Creasy, and she's on the call, so I'm going to turn it over to her.
Right. Yeah, Abla, if you would clarify for us, please.
Oh, okay, thank you. Larry, that kind of a situation, Stephen is correct. There are milestone-based the events that we actually follow, and not just the dollars. On occasion, a company thinks, or an entity thinks, that they're doing well, and we think they're not doing so well. We have in the past discussed with them grounds for termination because it's not consistent with what we're seeing, and that has happened. So we have control over that per what we're watching happening with the grant versus what they think is happening with the grant. And that has put us in the lead in managing the grant that way, both in terms of the actual work they're doing and then also the dollars they're spending.
So just to be clear, if it's our opinion that they're not meeting the milestones,
correct.
In fact, they think they are, it's our call to stop funding. It's not some joint decision, right? We get to say that's it.
We have the final decision. Sometimes they'll say it's going to take one more year, or the FDA told us that you have to wait for this or that. But once we decided that they're not delivering on the milestones that we pulled together in collaboration with them to start, then we proceed towards recommending termination. And I just want to, for the record, we have done that already. We have examples to share at some point.
Thanks. Okay, back to Michael and then to Kim after Michael.
I think Vito had his hand raised before I did.
Well, he did. I'm not seeing it on my screen.
It's because he's waving it. He's not a virtual hand. It's a real hand.
Okay. Well, Vito, I'm unfortunately handicapped in not seeing real hands on my screen because I don't have your picture. But let's do in the order I just described. Let's do Michael and then Kim and then Vito. Sorry, Vito.
Okay. I just back to the question about who makes the decision to cash in the warrants, if that's the right term. So theoretically, the warrants exercise, and you have up to a 10-year period, if I understand correctly, to cash them in. And somebody mentioned the president, and it just seems like that could become a process that's not complex, but labor intensive, right? To monitor if we have a number of these awards we're going to be giving out over the next 5 years, and it seems like that should fall into somebody's committee bucket, I think, but maybe we haven't defined that yet. But I would suggest that we would do that.
Yeah, one of the things that's entirely possible, remember, these are 10-year warrants and we've got a ways to go yet with funding. I'm not going to be the one to assume, because it was a really close call back in 2020. I'm not going to assume that there's going to be necessarily another round of funding for CERM. And so we can see these warrants, becoming exercisable, et cetera, after CERM basically has be running low on funds. So we're going to have to figure out a longer term mechanism for these, for whatever eventuality occurs down the road. And I think that's probably something we need to work on, after this meeting is really the back end of all of this, and having something that's a little more, laid out and structured. Kim, and then Vito.
Yeah, this discussion is way beyond my sort of finance 101 level of understanding. But if we were in possession of knowledge that a project wasn't going well and we're sitting on these warrants, wouldn't we then be at risk of some sort of insider trading to get rid of them before we terminate the grant? I see Steve shaking his head, so I'd just like to understand that.
Well, Raphael, can I answer that?
I was going to say, if you want to,
I've been in the public company in the SEC world for years. So the warrants basically, in and of themselves, can be transferred. You're right. And if we were aware of information that things were going poorly with a project, but we were able somehow to find, or somebody came to us and said, we're willing to purchase those warrants from you, we'd be in a position of not, and I'm speaking about this, I don't know about our insider trading laws applying to governmental entities. So let me have that caveat, because right now it's not clear how well insider trading laws apply to members of Congress. But in any event, we'd have to do a little legal research. Let me leave it at that, to see whether or not we have any exposure. But the better practice would be to basically not sell somebody something that's ultimately going to be worthless to them. That's probably not a very good thing to do, putting aside the legalities.
Thank you.
So Vito, I'm sorry.
It's okay. You probably can't see the conference room we're in. Change of subject question. What if one of our grantees that's exercised a warrant with CERM, for whatever reason, either business or financial, decides to go out of business or finds itself trying to reorganize in bankruptcy court? Are we a creditor? Where do we stand with respect to our warrant rights?
The warrant rights are essentially equivalent to either common stock or preferred stock, depending upon the type of the warrant. So in a case of a company, if they're really going out of business, so first of all, if there's a liquidation, you would be able to exercise the warrant into preferred stock and then get whatever liquidation rights preferred stock have. It's usually pennies on the dollar. And so, we'd have to wonder whether or not it's worth doing it. If it's common stock, you probably don't see much of anything. In a reorganization, typically the whole stock structure is redone, and you probably are left with very little, if nothing, in a Chapter 11 bankruptcy, which is the reorganization style. Chapter 7 being the strict liquidation style. So but in those cases, we placed a bet like the investors have, et cetera, and it just hasn't turned out. It's usually because the product that they're developing is, not met its goals. It turned out to not work the way everybody had hoped and expected it would. So, I mean, it's going to happen. You see it all the time, young companies folding simply because their clinical trials failed. So, we're not going to see much.
Okay, well, great. Thanks. Great answer. Thank you.
Any other questions before we kind of come to a vote on this? Or Sham, anything you want to add?
No, thank you.
Steve, I'd like to just a comment.
Sure. No, thank you.
Just a quick comment, and as we get to the vote here, I just want to, really put a shout out for Sham on this effort, because it is a lot of work. He's done a good job in shepherding the concept through, for us to be able to pursue those high risk projects that will hopefully have high rewards at the end from, you know, the therapeutics and the solutions that these products will bring. But we do apprehend this, as Steve explained, in those kinds of situations. So the risk is acknowledged. But I think Sham did a good job threading the needle and getting the input from everybody and really being very thoughtful and methodical in putting this together. So I just wanted to point that out, and thanks to you, Sham.
Thank you, Mohammed.
Yeah, before I call on Shlomo, let me just echo what you just said, Mohammed. This has not been an easy process, and just given the complexity of the presentation that we saw, all the different variables that had to be considered, I can completely concur. Sham, you really deserve our appreciation for the hard work that you put into this and the work product that you were able to produce. So I, for one, thank you for that. Shlomo, do you have
again, I re-echo those compliments. Absolutely. I just give a word of caution for us as the subcommittee, and certainly for Sham. When you make the presentation to the big board and certainly for the public, I think you're going to get a lot of questions about the disposition and the control of the funds at the end. So perhaps add an extra slide, just outlining the risks, the benefits, and the control that these assets will remain within the purview of CIRM, but based upon the answers that you gave to our questions, and your answers were terrific. So just a suggestion for your presentation.
Thank you, Shlomo, and you know, it's a good point in terms of even some of the confusion that was coming here with respect to issuance of warrants and exercising of warrants and liquidation of shares. Being able to clarify that and providing a real example of it would be helpful.
Yes, a great idea. All right, I don't see any other hands raised. No hands in the conference room. All right. Well, if that, then I would entertain a motion for approval of the proposal that Sean has put on the table, because I'm not going to repeat it.
So moved.
Is there a second?
Second.
So Michael has presented the motion and Mohammed has seconded. So Scott, let's do the roll call, please.
Sure, and I'd just like to ask if there's any public comment on the line.
Good question. Yeah, public comment.
And we're checking.
No hands raised.
No hands raised. Okay, great. Then I'll proceed to the roll call.
Yes. Aye.
Thank you. Kim Barrett,
Aye.
Judy Chow,
Aye.
Larry Goldstein,
Aye.
Gideon Bassiani,
Aye.
Steve Julesgaard,
Yes.
Shlomo Melmed,
Yes.
Joe Panetta.
Yes.
Great, we can hear you. Michael Stamos,
Yes.
and I'll check Maria Bonneville, Carol Watson. Great, thanks very much. And the motion carries, Steve.
Perfect. All right. Well, thank you very much, all of you, for your time and attention on this meeting. But I think we came to a good result, and I appreciate all the comments and the questions. I think we'll have an excellent presentation when it comes time for the ICOC meeting, assuming, of course, the Science Subcommittee approves. They better.
There's a reasonable chance.
Okay, good. I'm glad to hear that.
Great work, great meeting. Thank you. Yeah.
Have a great rest of your day, everyone. Take care.
Thank you.